Hello, I'm Sam Stovall, Managing Director, U.S. Equity Strategy. In this week's Sector Watch, found on www.getmarketscope.com, I told investors that the high beta, low volatility relative strength offered a superior risk-on, risk-off signal than the more traditional consumer discretionary, consumer staples comparison. Those investors anxiously awaiting a correction probably felt as if the S&P 500 betrayed them last month when it climbed more than 2%. But did the market telegraph that its return this May was going to be atypical of its average 1% decline during midterm election years? Technicians frequently compare the performance of the S&P 500 consumer discretionary sector with the consumer staples sector for guidance on the market's risk-on or risk-off trend. When the more cyclical consumer discretionary sector outperforms the more defensive consumer staples group, the S&P 500 is likely to enter into or maintain an upward trend, and vice versa. As of the start of May, this indicator was trading below its 10 and 40-week moving averages, indicating that investors should be on the sidelines. However, the S&P 500 high beta and low volatility relative strength was still above its 40-week moving average. After testing this average, it bounced rather than broke, signaling that the S&P 500's upward trend remained intact. What's more, a 15-year backtest showed that the high beta, low volatility on-off signal was substantially more profitable than the consumer discretionary consumer staples indicator. So a new and better mousetrap, in my opinion, is available by monitoring the relative strength of the S&P 500 high beta and low volatility indices versus the more traditional consumer discretionary and consumer staples sectors. Granted, past performance is no guarantee of future results. I'm Sam Stovall, and I'll talk with you again next week.